Hello everyone, I am Anamika Singh and I am an assistant professor in Department of BBA in IIMT College of Management. Uh, Today I am going to give an online lecture on financial modeling. In this video, I am going to give a brief introduction about what is financial modeling, why we study financial modeling, uh, what are the use of financial modeling in different sectors, and there are different type of models are being used in financial models. So one by one I am going to elaborate each and every model and what are their uses. So let's begin this session and understand what is financial modeling. So firstly, what is finance? Financial modeling can be explained as the process of creating a detailed summary of a business firm's expense as well as revenue in a spreadsheet format to help the financial managers make better decisions for the future. In financial modeling, for a financial year, what is the business firm's expense and what are their revenue in that financial year is uh, collectively presented in a spreadsheet in Excel sheet. It gives a comprehensive overview of expenditure and revenue earned by the company, along with providing the source where most resources are spent as well as where the profit came from. Uh, Not only represent only the what is the expenses and what is the revenue of that financial year. It also gives complete picture about what are the sources of revenue generation, in which area company is going to invest that money. This model will give a comprehensive overview of that all. The final observation and report of the analysis is then utilized by the financial analyst for different purposes, be it assessing the firm's stock performance and its impact on the future or making decisions regarding financial management. Financial model is used by a financial analyst not only to understand the uh, real picture of that firm. It also helpful for financial analyst to take various decisions. Maybe this kind of decision will be for merger and acquisition purpose, for taking the debt financing for any new project, or decision is related to investment in any project. There are several type of decision, which is first of all uh, that financial analyst analyze all the circumstances and make a more profitable decision in favor of that project. So financial model is very much helpful for financial analysts to make certain decisions. Now I'm going to explain what is the need to study financial modeling. We we know what is financial modeling, and now we will understand what is the need of the studying of that financial modeling. Financial modeling enables you to comprehend the foundation of the firm. What is the foundation of the firm? Any organization or any firm's foundation to rely on its what is the total assets of that firm, what are the liability of that firm, what is the uh, profit of that firm during a financial year, what is the mode of total cash flow of that firm. So in other words, I can say that the inner working of an organization or client will become immediately clear to you. Their income, their customer acquisition, their financial statement, their balance sheets, and so on by using financial model. So in this way, I can say the need to study financial modeling is very much clear to you. Uh, Financial model is very helpful for taking various decisions in financial field. There are different types of models are used in financial model. Uh, Restatement model, credit trading model, discounted cash flow model, comparable analysis model, merger model, leverage buyout model, model with scenario. There, these are different types of model which are used in financial modeling. These all models have their certain use. So one by one, I am going to explain what is the use of these models. Uh, for management, there are various decisions which a management have to take. Decision regarding the investment in any project. Decision regarding the what will be the share price of an IPO of a company. Decision regarding whether companies should divest their share or invest in any project. So there are various type of decision a management have to take. So for this all decision making, management use certain financial model. Uh, for management use for management purpose, three statement model and model with scenario will be used. If any organization want to raise capital in the form of debt for financing its project. There are certain models is also there which help the firm in taking decision whether it should raise debt for financing or it should raise more investment through it should invest in a project more through equity. This all will be clear through credit rating model and LBO model. Another one is for raising private equity. For raising private equity, three statement model, DCF model, comparable analysis model, model with scenario will be used. When any firm is going to take part in merger and acquisition, then there will be merger model and LBO model. So we can see that for different purposes, there are different type of model which is used in financial modeling. First of all, we will understand what is three statement model. A three statement financial model is an integrated model that forecasts an organization's income statement, balance sheet, and cash flow statement. For any organization, a complete financial structure of that company is clear by its income statement, which will give the summary of total net profit, net loss, gross loss of that organization in a financial year. Balance sheet represents the total asset valuation of that company, what is the liability of that company, what is the liquidity state of that company, and cash flow statement gives the total flow of free cash flow in that organization during a financial year. So these three statements, income statement, balance sheet, and cash flow statement, these three are the base statement for any organization foundation. So this three statement model connect these three income statement, balance, and cash flow statement in that format. Like when any change occur in income statement, that impact we can see in balance sheet, and similarly we can see the impact on cash flow statement. This model interlink in three statements together and make a foundation on which we can build another additional and more advanced models. These include merger model, DCF model, LBO model, and various other financial model types, including those seen in this chart below. In this chart, we can see that these three statement model, which connect these three statement, which are the base of any organization, like income statement, balance sheet, and cash flow. This model connect these three statements all together, and it will provide a base for financial analysis, for DCF modeling, for merger and acquisition modeling. It provides base for a scenario analysis if there is any scenario, and this model provide a base for taking certain decisions. This model is used for sensitivity analysis of any merger and acquisition. So we can say that the three statement model is the most important model in financial modeling, which is useful for various purposes of business decisions. Another model is valuation or DCF model. DCF model is discounted cash flow model. We know what is cash flow and what is discounted cash flow. The purpose of this model is to determine the valuation of an enterprise. Valuation of share is different and valuation of enterprise is totally different thing. So the purpose of this model is to determine the valuation of an enterprise. This model typically projects 5 or more years of future cash flow and discount those cash flow back to the present value. That's why this process is known as discounted cash flow model. I'm going to take an example and elaborate this model. We all know that the value of 100 rupees today is totally different than the value of money after 5 years. We know that after 5 years, the value of that 100 rupees which is present is going to deteriorate, and the value. What is the reason for deterioration in the value of that 100 rupees? The deterioration is due to discounting factor, and this discounting factor is none other than the risk factor. Risk factor is like inflation and many other risk associated in future cash flow. So this model actually used when there are different cases when an firm have certain projects and firm have to take decision. Firm has limited resources and certain projects are out there for their investment. So firm has to take decision which project should consider for the which project is more profitable for that firm to invest. In that case, DCF model is used. In DCF model, total this model typically project what will be the future cash flow up to 5 year or more year of future cash flow and discount that cash flow to the present value. When the discounted cash flow is present, this will compare with the present value of the future outflow and discounted future inflow. When future outflow is more than future cash inflow, then that project is not a profitable project for that organization. But when inflow is more than outflow, that project is more profitable for that organization to invest. So this model help in taking future investment decision for an organization. Not only this type of thing, not only taking decision regarding investment. This model is also useful in various other purposes, determining whether a company stock is undervalued or overvalued. This model is used to understand when any investor want to invest in company share. First of all, that investor will analyze the company stock value. If the company stock is undervalued, that investor is definitely going to assume that the company stock is undervalued rather than other similar company. So In the coming near future, the price will go rise. Certainly, there is a certainty that the price will be hike in coming future. When stock price is overvalued, in a coming future, the price will decrease definitely. So, in taking this type of decision, this model is also helpful. When price of a company share in an IPO, when a company is going to launch its IPO, what should be the value of that uh, price of that share of that company? This is also can be uh, this price is also decided by using DCF model. This model is also helpful to evaluating the fair takeover price for an entity. When two companies are going to take part in merger, that company first of all make this model and understand whether the valuation of this merger will be fruitful, or this merger is going to provide a synergy to the firms, or this will decrease the price of the share in coming future. This all can be done through DCF model. DCF model is also here to determine the value of enterprise during bankruptcy. When a firm declare itself bankrupt, this DCF model is actually used by the asset reconstruction company. When that asset reconstruction company is going to take care of that bankrupt firm, and going to restructure their asset. First of all, that asset reconstruction company uh, uh, should clear about what is the real value of that bankrupt enterprises. So the valuation of that enterprises is done through DCF model. So we can say that this model is useful in various way for taking various financial decisions. So this model is very much important. Another model is merger and acquisition model. We understand what is merger and acquisition. This model require making adjustments to create a pro forma closing balance sheet, incorporating synergies and term of the deal, modeling accretion and dilution, performing sensitivity analysis, and determining expected impact on valuation. This model, the accretion and dilution analysis, is done through this model, and this analysis determines if the post transaction earning per share is increasing or decreasing. The process of accretion and dilution analysis began with estimating the pro forma net income to eventually arrive at pro forma earning per share. And an increase in pro forma earning per share is regarded as accretion, while a decrease is regarded as dilution. When accreditation will be done, then that merger is beneficial for that firm. But when decrease in pro forma earning per share or dilution is the case, then that merger is not beneficial for that organization. So that firm or that organization should avoid that merger. So in this way, we can say that this model helpful uh, for making merger and acquisition decisions. Another one is comparable company analysis method. Comparable company analysis is also known as COMS in short. This more valuation methodology looks at ratio of similar public company and use them to derive the value of another business. This comp is a relative form of valuation, unlike a discounted cash flow analysis, which is an intrinsic form of valuation. We take only intrinsic form of valuation in DCF analysis. We only analyze that company. What will be the future cash flow, future inflow or future outflow what is the present outflow and future cash inflow. We only consider only the intrinsic form of the company. We don't compare that company with the another company which are the rival of that company in DCF model. But in COMS, comparable company analysis, we considered all the factors. We consider all the relative company which are rival to that company to understand and take certain ratio of similar company and use that ratio to determine is the company values overvalued rather than comparable company or undervalued rather than comparable company. If company value is undervalued, the valuation should increase for that company. If the value is overvalued, company should decrease its valuation for long-term survival in that market. There are many use of comparable company analysis, mark or market multiples or whatever name you use for them, typically performed by financial analysts and associates. The most common use of this comparable company analysis in IPO. When a company uh, is going to launch its IPO, what should be the value of earning? What should be the value of share price of that company? This is totally dependent upon which company is the rival of that company, what are the share price of that rival company, what are the valuation of that company with respect to their rival company. Is it is undervalued or overvalued? In this way, company actually take a certain ratio, compare itself with the rival, and decide what should be the right price of that share which is going to launch in the market. This analysis is also used for follow-on offering when the case of merger and acquisition. This model provides advisory to the merger and acquisition committee. Uh, when merger and acquisition is going to take place, what should the what price would offer for merger and what price would take consideration for acquisition? It totally depends upon the previous merger and acquisition takes place in that same business. After comparing the previous one to the present value, merger and acquisition advisory committee will decide what what price should be considered for merger and acquisition. This analysis is also used for fairness opinion, for restructuring of assets, for share buyout, for terminal value in DCF model. So we can see that comparable company analysis model had wide area to yeah, wide area where this model is used. Another one is leverage buyout model. And leverage buyout transaction typically require a modeling complicated debt scheduling and is an advanced form of financial modeling. And LBO is often one of the most detailed and challenging of all type of financial model, as the many layers of financing create circular references and require cash flow waterfalls. This type of model are not very common outside of private equity or investment banking. Uh, LBO occur when acquisition of another company is completed almost entirely with borrowed fund. There is usually a ratio of 90% debt and 10% equity. In that type of cases, leverage buyout model is used. So this was all about financial modeling, its uses, different type of model used in financial modeling. So that's it was all about this. This is all today lecture. So thank you everyone. Thank you so much.